Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the next thing that I wanted to sort of cover with you all is the idea of selling puts for new entries. So now let's just pretend for one moment that this natural gas ETF that we were covered call writing on, let's just say over the next few months it did rally to 23, but we cut off the upside and we sold a covered call at the $21 strike. So now we didn't participate on the upside, but we got to keep that 6% premium for the covered call. Now, suddenly we get exercised and we now are in cash with that portion of our portfolio and we're out of that. Well, what you can actually do is sell a put back down, let's say at the $21 strike, obligating that if the stock pulls back, I'll buy it back at the price where I sold it. Now, this is a neat strategy because in the end you were willing to own it down to 21. Now it's at 23. So now if we sell a $21 put, we're saying we'll buy it back at 21 if it pulls back down there. When you sell a put option, we're going to assume it's cash covered, but if you're doing it with leverage, it would be called a naked put. But it's cash covered put is where we actually have enough money on hand to actually buy the ETF if we're exercised on the put. And selling a put is a very viable way of actually entering a new position. So when we sell a put, if it obligates us to potentially have to buy an ETF at a specific price over a specific period of time. So understand that selling cash-covered puts is actually the identical risk-reward profile of covered call writing. It's in fact the same exercise. Go to any strategy screener and look at the risk-reward graph, risk profile graph of a covered call, and look at the one on a naked or a cash covered put, and you'll see it's the identical risk reward. If you can actually say that covered call writing is conservative, you also must therefore be able to say at the same time that put writing is conservative, because it's actually the same strategy. Understand the only thing in options world that actually creates risk is leverage. And options, in fact, can present numerous situations where you can leverage yourself. And that's what would make the strategy risky. But if you're using options as an alternative to stock ownership or as a way of entering or covered call writing, in fact, it doesn't increase risk at all. It, in fact, in many cases decreases risk or allows you to redefine the parameters of your trading that way. So in this situation, let's say right now let's just say we originally bought that natural gas ETF. I'm using the exact same example throughout today's presentation, that FCG, which is that natural gas ETF. But remember, we bought it at 18 and rode it to 21. What if we said we're not going to write a covered call? We're just going to sell it at 21. So now what we've done is we've taken our profits. We bought the ETF at 18. And we sold the ETF at 21, and now we're back in cash. But now what if we sold five $20 strike, 5-month $20 strike puts for 70 cents? That's actually, let's say, the bid price. What that means is that now that we've sold our original ETF position, we can now sell these puts. If we would sell 5 of these 5-month puts at the $20 strike, we would have collected 70 cents premium or income, saying that if the ETF pulls back $1, we'll buy it back $1 cheaper because I'm willing to buy it there. Understand, if you're exercised, you're obligated over that 5 months to buy the ETF at $20. But because you've made 70-cent income, your average cost based on your new entry is $19.30. So if exercised, you now own, you sold it at 21, bought it back at an average cost of $19.30, and you've now kind of did the the sell high, buy low kind of strategy in your ETFs. Now, if the ETF never trades down and gets exercised at the $20 strike, you at least made over the next 5 months 3.63% income. That's 70 cents income for while waiting to see if the stock pulled back. So even though you're in cash, in 5 months you just made 3.63% cash flow return while waiting for the ETF to pull back. And if it doesn't, we made the money. And if it does pull back, we now own the ETF back at a cheaper price. So it's almost like a way of running the cycle of selling high and then buying it back low and then selling high and following that kind of a cycle. Again, the question again online here is when and at what price would it get exercised? Again, you see it's a $20 strike. See the 5 month $20 at the first line there. Even though that natural gas ETF's at 21, we actually don't get exercised until only at the $20 strike. We're obligated to buy it at 20, but we got paid 70 cents per share, or $350 for 500 shares for taking on that obligation. But because we made that 70-cent income, $20 minus the 70-cent income creates that $19.30 break even, or a new average cost base on re-entering the position. I hope that clarifies it there for you. So yeah, I just had a question online here. So that was the way that you can actually use that put option as a way of re-entering. So understand, while someone that just trades ETFs but doesn't actually know how to incorporate an option strategy with it, you're really just buying and holding. And if you sell it, you're going to buy something else. You don't know what to rotate it. But if you actually understand a few of these option strategies, and you have, let's say, a diversified ETF portfolio of maybe, let's say, 7, 8 ETFs in your portfolio, or 9 ETFs. Well, now what happens is, as one of them rallies too high, you do either a covered call or you sell a put to buy it back at a cheaper price. What you're doing is that by learning these option strategies and educating yourself on that, you actually open a whole world of different choices of what you can do throughout that process of trading. Now, the next thing I want to talk about is buying puts as protection. A put option is a right to sell. So what happens is that right now, the reason we're using modern portfolio theory and other things, the only widely accepted method of managing risk is diversification. And therefore, everyone develops these broad-based portfolios of stocks and ETFs. And it creates that dilution or return. And it's frowned upon within the industry to create what's called a concentration in one individual stock. It's frowned upon. But really, if you think about it, when we're looking at it from this perspective, if we bought an ETF and we bought a put insurance policy on it to manage a downside risk, would it matter if we put a very large position of our portfolio in just the one ETF? In fact, if we have a put as an insurance policy protection, then what happens is that we've already quantified what the worst case scenario is. Now, there's another question online just asking what price of a stock is good for selling puts. That's such a broad question that's never right. Whenever you're selling a put, you have to understand what you're looking for. You know, if you saw that it moved a lot and you say, I want to buy 10% cheaper than where it is, then just look at what the premiums are selling 10% cheaper. You have to have a methodology to it. There's no right or wrong answer for that. It's just learning how to use that strategy. So now, what is it that I want to just ask you something. If you just owned an ETF and it started going up, right? Let's just say the natural gas ETF, you bought it at 18. Suddenly 2 days later it's at 18.50. Do you sell it? Well, let's see what happens. It goes to 19. Do you sell it? No, you don't know. Now it goes to 19.50. Do you sell it? Now it goes to 21. Do you sell it? If it goes from 21 back to 20, now that you had a chance to sell it at 21 and you didn't, do you sell it now back at 20? If it went down and then suddenly traded below 18 again, would you sell it? What happens is a lot of investors are simply not in control of the decision-making process, and in the end, they simply don't know how to define all the parameters of the trades. And what happens is that when you buy an ETF, and let's say you buy a very short-term protection on that ETF, what you've done is you've actually locked in your worst case scenario. We'll kind of look at it in a little bit of detail. Now, more often than not, people naturally approach risk management through stop losses. They say the traditional way is I'll put a stop loss in. If the stop loss is hit, I'll just exit the trade. Now, I want to just emphasize, how is it now? First of all, let me just go back for 1 second. I just wanted to clarify that the first example, we sold a put, which obligated us to buy it. So now in this second half of this, talking about puts, we're now, rather than selling a put, we are now buying the put, which gives us the right to sell the stock at a specific price. And therefore, we removed all the downside risk of owning it because we have the right to sell it at a very specific price. So now when we have the right to sell something at a very specific price, it allows us to stay in control of the process. And the first disadvantage of using a stop loss order versus buying a protective put. Now let's just go two scenarios. Now let's say we bought originally that natural gas ETF at $18. Now what if an investor said, I'm going to just put a stop loss down at 16, and if it hits 16, I'm out, but I'm targeting $22 on the upside. The one thing that if you just use a physical stop loss order, you become susceptible to volatility stop out, which means the ETF trades down, hits the stop loss, reverses, and actually rallies, but you're not in it because you got hit on your stop loss. Now understand, if you, let's say, bought the ETF at 18, and let's say paid 40 cents for a 1 month $18 strike protective put, that put for 40 cents, you paid 40 cents out of your pocket, but it guarantees you, let's say, over the next month that you have the right to sell that ETF at 18. In other words, you have all of the upside of the ETF, but your downside is limited to the 40 cents because you're guaranteed over the next month that you can sell at 18. Someone that uses a stop loss didn't pay the 40 cents, but understand, if you owned an $18 strike protective put, and that the stock or the ETF traded from 18 down to 15 and it rallied back to 22, you never were stopped out. The put gave you the right to sell it, but you didn't have to exit the position early. You could have held it for the duration of the protection. The other thing with stop losses, let's say you said, I'm going to put a $17 stop loss on this ETF. If suddenly it trades down, if that, let's just say one of those ETF stocks, one of those natural gas stocks came out with really disappointing earnings, and all the natural gas stocks gapped down. And suddenly the ETF, which is, let's say, trading at $17.10, if the next day that the ETF opens at $16.75, you're not filled at $17 where your stop loss is. You're actually filled at $16.75. So in fact, you had slippage on that. But understand, if we owned an $18 protective put, no matter what, we know we can exit the stock at $18, and slippage just simply doesn't happen. So let's just, again, using that example of that natural gas ETF, in this situation, if we bought it back at 18, now here's an example. This is actually what I like to sometimes consider doing, is once you feel that a stock has already rallied. So we bought that at 18 and rallied. We originally put $9,000 to buy that ETF for 500 shares, and let's say it rallied to 21. Well, we're now sitting on $1,500 profit. So think about this, all right? So we're now guaranteed $1,500 profit if we sold it at 21. Now, let's say feel that there's a risk that natural gas can pull back, but we want to see how much farther it can go. So really at this stage, if we bought, let's say, a 6-week or 8-week March $21 protective put, it costs 60 cents. Now think about this. We now are going to pay, sorry, that should say ask, not bid. We pay 60 cents for the $21 protective put. Now we buy the protective puts as a hedge. Now we pay 60 cents times the 500 shares, basically $300. So we're sitting on $1,500 profit. We say we're going to take $300 of our profit. And we are going to guarantee that no matter what, we can sell this ETF at 21 bucks. Now, we have all of the upside potential of the ETF. We're not forced to sell it at 21. If it rallies to 22, 23, 24, 25, we keep making money. But if it reverses and drops down, we know we can automatically guarantee at our exit at $21. Now this here at Option Source, we call this our risk-free trader strategy. And what we do is anytime we have an opportunity on a stock that we're up on, if we can turn around and buy a protective put to make sure that we lock in the profits, have all of the upside of the stock, and there's absolutely no way we can lose money because we bought the put to hedge that risk, we call that a risk-free trade. And so we strive to create those trades all the time where we can find a way to actually remove the risk of actually owning it. So in the end, this one here cost us basically just around 3%. And so we paid 3% out of our pocket. We're not going to get that 3% back. But understand what we've done is we've paid 3% but have all of the upside, and we've locked in the sale price. Now the next thing that I wanted to touch on here is using an option as an alternative to owning the underlying ETF. So now I wanted to just demonstrate something to you in a simple scenario. Under the first scenario, let's just say if you wanted to, you could buy 1,000 shares of that natural gas ETF, let's say at $21, and it's going to cost you $21,000 out of your pocket to buy that. Now, alternatively, if you chose not to buy the ETF, let's say you say there's too much risk that the thing could pull back. So you want to find a way to manage that risk. So now we're not using a call option for leverage. We're using it as an alternative to owning the stock. So in other words, we need 10 call options because each call option represents 100 shares. So we're going to need to buy 10 call options. So instead of actually forking $21,000 out of our pocket, we instead keep $21,000 sitting in cash. And we alternatively buy to open 10 call options at the $21 strike for 2 months. Let's say in this situation they're asking 70 cents, so we pay 70 cents to buy those call options. Now, that means that in total, the call options cost us $700. Now, so that means if that portion of our portfolio, we had $21,000 allocated to it. Well, here, in the first scenario, we actually had to really put the $21,000 in the market. Under the second alternative, we only had to put $700 in the market, and we have $20,300 sitting in cash. Now, let's just say the market crashed. Let's say there's a flash crash that just happened tomorrow. And boom, the market's just crashing, and it's another bloodbath on the markets. Guess what? The person that owns the 1,000 shares might be down to $17,000 or $16,000 on the ETF as this ETF shaved off $4 or $5 on a pullback, while the person that owns the call options cannot lose more than $700. And no matter what, has the right to buy the shares at $21, so continues to have all of the upside, but can't lose more than $700, right? And therefore what happens is that a lot of times you can use a call option like that as a way of actually saying that I know how to quantify my worst case scenario. In terms of how bad something can be if the stock starts to really drop. So learning, and now obviously some people will say, well, you know, why can't I buy 20 or 30 call options? Well, now what you're doing is you're leveraging. Remember, like I said earlier, options are not really risky. Leverage is risky. And if you utilize options as a way of creating risk, or creating leverage, that's where the real risk comes associated to it. So in this example, I really want to emphasize is that we didn't want to leverage here. We simply wanted to create one scenario where we own the stock, two, where we synthetically have all of the upside of the ETF. and our risk is limited to the premium we paid.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.